Thursday, November the 27th. Delighted to have Paul Horsnell and Daniel Rahmat with us, two of our regular analysts and commentators on the program. And I'd like to welcome Giacomo Prandelli, who's based in Switzerland, commodity analyst and geopolitical strategist, founder of the Merchant News. Giacomo, I'll come back to you. Paul, good morning. Paul Horsnell, chairperson of the board, Oxford Institute for Energy Studies. Great to have you with us. Let me get your perspective, Paul. Since we last had you on the show, we've had different obviously factors impacting sentiment in the market as the year comes to a close. Russia dominating the headlines the last 2 weeks or so with the Lukoil, Rosneft sanctions, and yet seeing the Trump administration really not on the international foreign policy front, really squeezing Russia in these talks that we've seen the last week or so. How is the market interpreting the pressure on Russia from an oil sort of supply point of view ultimately? And does it make any difference, that recent diplomacy we've seen from the US and Europe for that matter?
Yes, morning, Diana. I'm not certain that the market's taken a huge amount of note to it. I mean, it's still Brent's holding above 60. All the directional indicators are very low, which means there's no real trend on the market. It's still backwardated for the first 5 months, and it's pretty flat for the 5 months after that. So it's all pretty calm. There hasn't been any unusual increase in volatility, and so in that sense, I'm not certain that it's necessarily been driven hour by hour by headlines about Russia-Ukraine. Having said that, clearly some of the softening over the course of the last week or so has been those sort of headline related, but it's had no follow through. It hasn't continued. And I think that partly now, after sort of 3 years and a few months after the war started, I think that's a reach point where the market's not expecting there to be any sudden rush of Russian oil, even if war finished and all sanctions were lifted. I think the market knows that sanctions are not going to be lifted immediately, even if the war came to an end. Remember, a lot of those European sanctions are to do with the annexation of Crimea. I mean, there's sanctions going right the way back. Given the current positioning of Russia in Europe, with the spy ships, the drones on European airports, all kinds of other subversive stuff going on. This doesn't feel like anything that should lead to a sudden rush of Russian energy coming onto the market. So overall, I think market's very interested in those headlines, but it's still saying, hey, look, we're strong. There's no surplus. It's backwardated. No huge downwards direction. And so it feels slightly decoupled from what the press is writing about and what the analysts are writing about, and what the market is doing seem to be totally different planets at the moment.
Okay. Giacomo, welcome again. Great to have you on the show for the first time. This is our last week of the year for the show, but we look forward to having you again, hopefully next year as well. You're based in Europe. I mean, sticking with the sort of Russian sentiment, if you like, on there's been obviously peace talks happening over the weekend, plans being adjusted and changed. But Europe, of course, has taken a big stand and an adjustment since the war started, but also pledging not to take any gas from 2027, still is taking gas at the moment from Russia, what it can get. How is Europe from a sort of supply point of view looking at Russia, particularly the gas situation? And I mean, as Paul said, even if we had a peace plan tomorrow, it'll take a few months for any change in fundamentals to filter through. But how seriously is and how concerned is Europe that these peace talks really aren't progressing?
Yes, hello, Diana, thanks for having me. So Paul mentioned a few important points. So the fact that now the prices are not lowering as much as we are expecting, like due to the peace talks, is already a sentiment. But regarding Europe, the demand of gas, especially the US LNG, is increasing a lot in the latest year. The numbers are pretty impressive. With the latest data from the European Union, we saw that there is a strong decreasing in the import of the gas, Russian gas, even if, of course, it's cheaper than the US LNG. But still, I think this is the path. Europe already signed a lot of agreement, especially with the US. to develop all the infrastructure to import the LNG. So I think this is a growing trend. And of course, if we speak about the peace between Ukraine and Russia, as Paul also mentioned, it's important to understand that Europe cannot modify or change their decision to stop importing Russian oil and gas. I think this could be a strong card for the peace because Russia is a key exporters and their business is also based on that. So we will see what happens, but the prices, of course, are dropping. We saw the levels for the WTI around 60, and now is even lower, and the Brent below 65. Those are the latest, let's say, price target of the latest month, and they are below. I don't know, like if the market wants to drop even more, also because Russia, at the end of the day, like is sustain also this war with the income of oil and gas, and so lower price, lower income for them, and also this is a sort of weapon that US or other key players are using against Russia.
Of course, and I mean, not just the price, which has obviously been declining, although the price outside the non-Russian oil price is inching closer to the discounted Russian price, which is obviously makes that more difficult for them. But it's the infrastructural damage also that seems to be hitting home a little bit more, at least as we go into next year. Daniel, good morning again. Daniel Rahmat, Senior Energy Security Consultant in Iran. Let's talk about sanctioned Iranian oil and what that's been doing as the year comes to an end. I mean, the figures we've heard about, that it's been pretty consistent, that 1.5, 1.7 exports has not been impacted despite talk of tougher secondary sanctions, etc., on Iran in the last few months from America. But more importantly, Daniel, as we go into the next quarter, how is the geopolitical situation shaping up around the country, and do you see any flags there?
Hello, Diana, and hello, everybody. Very glad to be here again. Yes, Iranian oil exports has been consistent, and to some extent, we can see it's been steady. And there was a growth, but not very much. But there was a growth of exports to China. Well, in some terms,
you mean growth when? When is that period? Growth since China stopped taking a bit less, or growth in general this year? What do you mean by that? Because China was holding back a little bit for a while, wasn't it?
Yes. In general, during the last 12 months, Iranian oil exports to China has grown. Recently, the amount of Iranian buildups in Malaysia and Singapore has increased, but in general, Iran's oil performance was, let's say, remarkable, considering the pressure on the plate, considering the pressure on the teapots, and also some restrictions on the money transaction system, which is called the shadow banking system. But in general, Iran is now feeling more pressure from Russian oil coming to China and should offer more discounts. So the level of discounts has increased very significantly. Now the average of discounts is between $8.5 to $10 per barrel, which is super huge and very beneficial for Chinese refiners. But Iran has no other way. Iran wants to keep its market share in China, and that's a very big issue for Iran. Considering problems with transferring the money to Iran, which is not due to the sanctions, but is due to the conflicts between the CBI, Central Bank of Iran, and the quota holders and the money transferring system. And now the government is in a very bad financial crisis. The monetary base has increased very significantly after the war with Israel. Rial had lost more than 30% of its value after the war with Israel, and now the government is in a very serious financial crisis. But apart from that, the geopolitical situation in the region is very, very intense and volatile, let's call it, because Iran, Israel, and the US are in a situation which I call it no peace, no talks, no war situation. This cannot remain. It cannot remain actually stable forever. Iran is trying to rebuild its military capability. There are no significant signs of rebuilding its nuclear capacity, but there are potential there is still a possibility of a crisis between Iran and Israel.
Yeah,
This has impacted the domestic economy, and there would be possible problems for Iran in the future.
Okay. Paul, I mean, let's talk a bit about the tariff situation, how that might be impacting, economic sentiment. We've had the tariff story, of course, playing all year, April onwards, much more significantly. But again, the US conflicting messages, I mean, you could say it's played a very weak hand with China and Russia, not on tariffs, but Russia in general, in terms of coming down on it, picking on its allies more, Europe, Canada, etc. US economy again beginning to show signs of strain on the street, but markets doing very well. So do you feel that the tariff uncertainty is, from your indicators that we see on the ground and industry, beginning to hit home in the US? We'll talk about China as well, but in the US in terms of manufacturers, in terms of economy there.
I think there's two aspects to it. I mean, first, obviously, markets are reacting to average tariffs, which are considerably less than perhaps they've been looking at, come April, May, and after the initial shock of the tariff announcements. And so, while US average tariffs are very high historically, they're not quite as high as perhaps people had feared at that point. And the rest have said it clearly. I mean, nobody. But so no economist would tell you that a tariff is going to be neutral in terms of its impact on the consumer. It is essentially a tax, works as a tax on the consumer. It's not a tax on the foreign country. It's a tax on Americans. It does feed through into inflation. There is a lag attached to that. But where you would tend to see it is very much in those areas of the economy which are very reliant on those on the flow of cheap imports, which are now those retailers are having to start pushing some of those costs through. So I don't think any of that is unexpected. I think generally, in this taking terms of the oil market, I think the oil market is probably is baking in a much more benign view of the world economy now than it was before. And see, the path of demand growth estimates has been upwards. And there's all this talk of gloom, but the demand growth estimates increase. I'm looking at 1.1 million barrels a day this year, 1.5 million barrels a day next year, as some of the negative year-on-year effects work their way out. That's not a bad outlook. I mean, it's certainly, and again, certainly much stronger than some of the doom mongers were coming up with earlier. So, and again, wouldn't be too concerned about that sort of stress showing on the US situation, because what do you expect if you put tariffs like that on? I mean, that's not a surprise. I think the more immediate question marks are going to be on the Fed and where will the current interest rate cutting cycle stop? How much baked in inflation is there? How much of that is temporary? How much of that is permanent? So again, not enough to, I think, to rattle the oil market, given some of the fears it's been operating on over the course of the most of 2025.
Yeah, and of course now we're at the end of November. We're going into Thanksgiving weekend. That shuts things down pretty much in the US, and we're into holiday season. So perhaps it'll be all quiet on those indicators until we hit into the new year. Giacomo, I mean, let's talk a bit about China. I know you're based in Europe, but from the point of view, what strength or not China's lending to oil markets, to other commodities such as copper, etc., as it ends the year also with a probably more positive year economically than many were predicting at the beginning of 2025. From an oil market point of view, China has been supporting also by taking a lot of stock into its inventory. But again, any indicators there as we go into next year on how much support China is going to give commodities markets and oil as well?
Yes. So starting with oil, we saw that China developed a huge stocks in the oil market. I think this is also due to the fact of the prices. They saw a nice, interesting prices. They decide to import more and to create huge stocks. On top of that, we saw also the situation not only with Iran, as Daniel was speaking about lately, but also with Russia. So they are importing to lower prices. If you compare to Europe or US, this is another advantage. They're also building a nice infrastructure. Of course, their demand of energy is growing higher and higher, so they need fossil fuels. Of course, they also have the new renewable story, but at the end of the day, they're still running on coal, oil, gas,
On everything,
and
yeah.
yes, on everything. So they need that. They need it. But speaking about metals, they are the key players. We saw the situation with rare earths, but not only there. Like we speak about copper, they are the biggest worldwide in the refinery space, and we also saw like lately there are a huge problematic with the copper mines worldwide. We saw in India, now we saw Anglo American when I purchased Teck, the Canadian copper mining company, that they have a few problems with the forecast. We saw the situation with Codelco in South America. So all the forecasts for the copper production are decreasing, and this is another huge problem because less copper, the prices are going higher and higher, and already in the European market, the premium are getting higher. So for the foundry segment, for the brass segment, the price are going to skyrocket. And here already China has a lot of stocks, and so they can sell it and also here make an interesting profit. So
Okay.
that's the end of the story. Like they play in advance, they have the capital, and they are playing smart.
Okay. They do certainly play it smart and patiently, Daniel, as does Iran, actually, on many fronts. Daniel, let's talk a bit about, I mean, we're talking about prices here. I mean, oil prices, many forecasts already being put out for average predictives for next year, $60 average. So we don't look like we're going to shift much from the average price we've seen in the last 6 months, at least next year. OPEC is going to be meeting this weekend on Sunday, I believe. What do you think will be the top of their agenda, given all the dynamics they have to consider?
Well, actually, through an Iranian perspective, Iran is not involved in such decisions due to the sanctions imposed on the country. But if I were the one who is making decisions in the big countries in OPEC, I would consider that there is, before maybe 6 months ago, there were concerns about the possibilities of the impacts of the US sanctions and the volume of Iranian oil exports to China, as well as possible drop of the Russian deliveries. But now I can very clearly say that such sanctions were not that effective. The US would either sanction the Chinese infrastructure or would directly engage with the Chinese refiners and the Chinese government, or should forget about the cut of Iranian and Russian barrels going to China. India is a totally another story, but in China is very committed to continue importing oil from Iran and Russia, more importantly because of supporting its ideologic allies in Russia and in Tehran. So I personally believe that thinking about the cuts from Iranian and Russian barrels would be somehow very optimistic for other oil producers. So if they continue increasing, actually adding barrels to the market, even sustaining the $60 per barrel would be somehow a little bit impossible if they continue to do so.
I mean,
I think they should possibly stop increasing the volumes of barrels going to the markets, and otherwise
well, I mean,
they
they're
should
planning,
be ready
sorry,
for
that,
more.
I mean, they're planning to do that, aren't they? Okay, thanks, Daniel. Paul, going to you. I mean, the plan for the first quarter is to stop increasing and adding back barrels to the market, and that seems to be a logical decision now, even more so as we get to the end of the year. But of course, OPEC Plus can always do it at once, or can it? This question of sort of spare capacity. Saudi has some, UAE has some, but again, the market talk in the last few weeks has been, there's actually not a lot of spare capacity, and it's better for OPEC Plus, led by Saudi, to always have that cushion, hold that back. Is that, do you think, an issue going forward? I mean, then you have the supply glut talk on the other side of that. But, and also factoring in, Paul, non-OPEC supply, from the US, etc. So is there any panic whatsoever on supply next year if economies, continue to tick along nicely, if you like, as they have been?
And starting on non-OPEC supply or non-OPEC plus supply, I think most of don't get too distracted by year-on-year momentum. If you look at just month-on-month momentum, nobody's really got any particular incremental non-OPEC supply coming on next year. And everything is sort of flatlining the big year-on-year increases, the Guyana, the Brazil, those Friday, Canada, more lumpy increments in 25, just not there in 26. So in that sense, I think a lot of that supply side pressure is abating just simply because that lack of, again, don't get confused on the year on years because they can get misleading, but just how much is coming on month by month, quarter on quarter next year, and it really isn't that much. So in that sense, I think what the market is looking at is, look, we've been talking about supply glut and impending supply glut for about a year now. And show me, where is it? It's not there. If we take the EIA numbers, the maximum surplus was in October, over 4 million barrels a day. There's enough time for all of that to come to market, all of that surplus. It's not there. It's not in the US stats. It's not in anybody else's stats. So in a sense, this supply glut thing, I think most people must be getting rather bored by it. I mean, it's something that produces analyst reports and headlines, and let's see who can put in the lowest number and the biggest size of glut. And it's just not there. It's just not there. And at some point, this disparity between what's actually going on and what people say has been going on, you've got to break it. And this past year, I think, has been a pretty low point for analysts' profession as a whole.
What do you make of the
worry
IA?
about supply glut, but just be more on policy and on that supply thing. You'd expect a seasonal surplus in Q1. That's normal. The question mark for the market is, it's the surplus this year. Is it just the normal seasonal one? In which case, forget it. It's already been priced in. Or is there really ultimately, finally, a somewhat larger than the normal surplus running through Q1? And then you look at the back end of next year and say, hang on, demand's trundling along quite nicely. Non-OPEC supply is leveling off, at least temporarily, incrementally. OPEC Plus seems to have it all pretty much under control. Spare capacity is extremely limited. I raise a question mark on how much spare capacity the UAE has, but there seems very little spare capacity overall. So some in the market say, well, hang on a minute, I'm bored with just selling this market on the basis of impending glut. Looks so much tighter in the second half of next year. If this is just a seasonal surplus, well, then let's get ahead of it. Let's start positioning for an uptick next year. And I think that's why we're getting to the point where the resistance to short-term surpluses is getting less and less and less because they're clearly
but how much? Okay, well, Paul, let me just interrupt you there, and just how much of that is reliant then, that point of view, on China continuing to do what it's been doing in the last few months, which is, apparently, of course, we don't always have accurate figures on their inventory, but a lot of people saying, well, if China suddenly stops stocking up, then that could lead to that glut, if you like, materializing. Whereas, how important is that factor, do you think?
Well, I think we've got to be careful here. I mean, in some cases, what's happened is analysts have forecasted a glut. The glut's not there, so they're saying, it must be in China. And so some of that inventory build in China isn't real. It's just, it's an error from people's models, and they're throwing it all into China. I've seen suggestions that China is stockpiling above 1 million barrels a day. It clearly isn't. I mean, I think what's happened through this year is the continuing strategic stock build. Maybe it's peaked as high as 500,000 barrels a day in some months, but it's probably averaged, less than 250,000 barrels a day. I mean, it certainly hasn't absorbed all of this glut that's supposed to be in there. So I think we've got to be slightly careful. China's strategic build is across a whole series of commodities. I think it will continue, but I wouldn't accept the logic that the only thing that's holding the market up is China. Taking in the glut. That just feels like, again, predicated on the existence of a glut that isn't there. I mean, we're asked to believe in ghosts, that there is this huge glut, but the fact that you can't see it, don't worry, it's really there.
It's really there, but it's not really there.
I'm not going to believe in invisible surplus barrels anymore. I want to see.
Okay, well, another thing that is sort of invisible is geopolitical risk. I mean, yes and no. Obviously at the moment it's sort of in the background there's our question, how much geopolitical risk is the market factoring into today already into oil prices as we end the year? What's in there already? What's been there's the argument that it's just built in and it's just consistent and stable. Which one of those three? None, or less than 5, or above 5%? Giacomo, let me go to you on that. I mean, just generally, commodities markets, oil markets, how much support are we getting from this geopolitical risk factor that's always there, but of course is very low these days, considering how much it could be or should be, let's say, if you look at historically how the market has reacted to, instability, whether it's Europe or Middle East.
Well, from my point of view, like at the moment, like the geopolitical risk is very high, and is just gonna getting lower in the future. That's my point of view. Like,
Okay.
if
How high how many dollars would you say is in the price today?
so, like, I think like if like they will be capable of finding a solution in the Ukrainian-Russian war, I think like the price should drop a little bit more, just because of the headlines, just because of the geopolitical sentiment, and after that, like everything can go back and to previous levels and also higher level. That's my view. So I expect the oil to go a little bit down, like also below the 60 levels, also close to the 50. And next year, as Paul was mentioned, maybe the beginning of Q1, these low prices will stay because of the possible surplus. But after that, surely the price just can go higher and higher, because like what we saw is that the demand is there. Of course, China is the key, let's say, client for oil. Like they are the biggest importer of oil, and so it's important always to check what they're doing. We also know that from time to time the data from China are not very transparent.
Yeah.
Okay. But still, they are one of the key players with India and also, of course, the United States. But their production, also the latest data about the production of US, this year they're increasing. Like they are really pushing up their production of oil, even if with these low prices, even if the break-even, let's say, cost of the US production. We saw very high level in Guyana. They just reached the 900,000 million barrels. So this is a historical record. They want Exxon, especially, is one of the key players there. Others are coming, but still Exxon is a key player. They want to implement and increase the production over there. What I'm just thinking about, due to the geopolitical point that you just raised, is about possible merger and acquisition for big companies, such as, I don't know, the Russian oil company, Rosneft, Lukoil. We saw that Gunvor, a key Swiss trader, tried to make an offer to a purchasement of some refineries, but still the US is against that. I think this is just about geopolitics. This is just about how you want to play. And
I mean, well, like you said, companies, I mean, even Lukoil and Rosneft are looking to even restructure some of their holdings in the more immediate impact, so they're below 50%, and they can argue that, okay, it's another majority holder who's operating those assets. Thanks, Giacomo. Daniel, let's go back to you and get an update as we wrap up on the domestic situation in Iran. I'd like to get the vibe from you there. We have one headline today saying Hezbollah won't retaliate against Israel. Of course, we've had some activity again in the south of Beirut and continuous bombardment by Israel in the south of Lebanon, really, which doesn't get reported every day. But, saying Hezbollah's keeping quiet despite Iran calling for revenge. And we also hear headlines in the FT yesterday saying not a new group of people, but people within the administration in Iran's leadership looking to improve relations, across the board with everyone. So where are we domestically now, 6 months after, what we saw at the end of June, and with some nervousness as we go into next year?
Yes.
I mean, is the leadership showing any leeway domestically that it is going to continue to keep things peaceful from its point of view, at least?
Right. Look, Diala, let me very shortly go to the geopolitical factors. With very much respect, I disagree with Giacomo. Giacomo, I think the geopolitical factor at the moment on crude is very low comparatively, because the Ukrainians are mostly targeting the Russian refinery infrastructure, not the crude. So in terms of refined products, yes, there were less deliveries, but crude there is more than enough in the market, and Iran and Saudi Arabia are in the best historical relations ever. So there is no threat to the Saudi Aramco nor to the UAE infrastructure. In Africa, situation is better than always. In Central Asia, Kazakhstan has resolved problems with Russia. And so in Iran, there is a little risk for actually a tanker war between Iran and Israel. Time to time, they accuse each other. Iran accuses Israel for targeting some vessels. But in general, the geopolitical risk is very low. The sanctions risk, I divided from the geopolitical risk. So with very much respect, I think that we have very little geopolitical risk.
Disruptive.
Almost no dollars per barrel. Regarding Iran situation, there are some good news. Saudi Arabia has asked the US to mediate between Iran and the US, and there will be talks in Paris between high-rank Iranian officials and Saudi officials. Saudi Arabia has asked the President Donald Trump to stop Israel for making disruptions in the talks between Iran and Saudi on behalf of the US. I'm not sure whether US can guarantee to prevent such an action from Benjamin Netanyahu, who very much likes to sabotage any kind of peace between Iran and the US. But at the same time, there are Iranian officials very much emphasizing on making peace in the region. As you know, that the person who was killed, assassinated recently in Beirut, was the highest person in the Hezbollah's military ranking. But I'm not sure. I don't believe that Hezbollah would retaliate, or at least very seriously, because everybody in Lebanon is tired of such nonsense wars and destruction of the country. Many in Iran support this idea that Hezbollah should not risk the existence and the future of the Lebanese nation. So I think there will be positive actions from Tehran. The leadership has stepped back from many actually controversial policies, especially on actually social rights of the people, hijab, etc. So let's see. I think Iran is seeking peace. Iran is seeking a kind of deal. At the same time, Iran is very much engaged with the interests of Russia and China in West of Asia, because Iran needs an umbrella, kind of umbrella, let's say, from Russia and China to be able to make a good deal with the West. But that umbrella would be closed if they understand that Iran is going to shifting towards West. So Iran is in a very, very special situation. Wants to come back to the global mainstream. Iran understands that in competition with Turkey, in competition with Pakistan, in competition with Saudi Arabia as its regional rivals, needs to have better connection with the world, needs to do trade, needs to sell its oil, needs to actually gain investment. But at the same time, the security ties and the network it has made in the region has put the country in a situation which it makes it hard to shift from one side to the other. So making a balance is very complex, and the current economic and, more importantly, environmental situation in the country, there is no drop of rain coming in Tehran. This is insane. We hadn't had such thing for 100 years. So the situation is very complex, but I hope Iran can make it.
Well, inshallah, as they say. Thank you so much to Daniel and to Paul for being with us all year and committing your time and insight to the podcast. And of course, we'll be back on January the 8th with our Global Energy Outlook Forum and kicking off the New Year season there. Giacomo, thanks for joining us today. Good to have you with us. So have a great weekend ahead, everyone. And, happy holidays to those celebrating, and peaceful New Year, hopefully, for everybody. Thank you so much.
Thank you.
Thank you. Bye.
Bye.
Thank you. Bye.
Goodbye.